Hey, what's up, YouTube? Welcome to the Live Econ Guy. Guys, today I want to talk about the recent hikes in interest rates by the Fed. So the ultimate question is, when will the Fed stop hiking interest rates? And I think it's a really good question because the interest rates, the federal funds rate that they've been hiking in the past couple of months, it has an impact on mortgage rates, it has an impact on credit card APR, auto loans, everything essentially. So when will they stop this? Um, so we had the CPI report which came out today, and inflation is actually higher than it was in August. Inflation expectations, rather. Um, I mean, that's a pretty clear sign that they're going to continue to hike interest rates because they're saying that they're not stopping until inflation is down. And one problem is that the interest rate hikes that they're doing, it takes half a year to a year for it to actually show up, any kind of effect to show up in the economy. So what we see in the next CPI report is probably not going to be that much different, and they're going to continue hiking. Um, but guys, essentially right now, the short-term interest rates, which is the federal funds rate, we're essentially at neutral. So the effective federal funds rate, it's at 2.33% according to um, the Federal Reserve. However, that's not their goal this time around. So um, in the last couple of years, the Fed changed their policy, and I'll leave this link down in the description, which kind of describes it. So they're no longer targeting short-term interest rates. They're now targeting long-run. They're essentially targeting the long-run average, which nobody knows what that means, but that's kind of how they're making their decisions, is they're targeting that long-run average. And guys, if we take a look here at this graph, this is the federal funds effective rate divided by the 10-year Treasury yield. I think this tells potentially a story which can help explain when the Fed will stop hiking interest rates. So the Fed funds effective rate is the short-term interest rate, and the 10-year Treasury yield is essentially a proxy for the long-run interest rates. So when we take this quotient, we kind of get this something that looks like this. You could see the 2007-8, the 07-08, the financial crisis. There's this sharp spike down, and essentially any time that there's a recession, there's this massive spike down. Now, guys, if we look at the long-run equilibrium between these two, and this is from 1962 to 2022, we get a value of 0.71. If we look at the short long-run equilibrium, which is the last 10 years, which is something that the Fed mentions in their article, using the 10-year mark, we get a value of 0.3. So if what they're doing is they're targeting the long run equilibrium, which is that 0.71, they're going to need to increase this ratio, which currently stands at around 0.8. They're going to need to increase it for an extended period of time in order to reach that 0.71. Now, what that means is that essentially the Fed funds rate, it has to be at or above the 10-year Treasury yield. That way, we're going to reach that long run equilibrium of 0.71 faster. If it's below that, it's going to be a very long process. So what I think the Fed has to do is they have to hike the federal funds rate at least to what the 10-year Treasury yield is, and even higher, which is something that we see throughout history. Essentially, that way we'll reach that 0.71. I think that's that might be what their goal is, but it's very confusing to understand what they're actually doing when they say that they're targeting the long run average. Now guys, another thing that comes up here is the sale of mortgage-backed securities and treasury securities, which is something that the Fed has announced that they're going to do. So if they do that, then they're going to push the long run interest rate up. If they do that, then this ratio that we saw here, it goes down. And if it goes down, then the Fed has to increase the federal funds rate as well, the federal funds effective rate. So that's a risk of selling any of the bonds that are currently on their balance sheet. I think that's why they are instead using a strategy of allowing those to roll off so that they're not saturating the bond market with all these bonds. So I think they'll be lucky if they don't have to sell them and they can just allow them to sit on their balance sheet. That way they don't have to hike the federal funds effective rate, the federal funds rate even more. Guys, I think what the Fed is ultimately going to end up doing, like I said, they're going to at least be at that 10-year Treasury yield, which is currently 3.6% as of today, which is September 13th, 2022. If they, like I said, if they do end up selling some of their bonds, they're going to have to hike it even higher because in this ratio, this is the denominator, 10-year Treasury yield, and if that goes up, then they have to follow up with a federal funds rate hike. And I think what they've been doing is they've been getting ahead, because if they do sell some, then there's that, they have that cushion where this ratio is not going to go down a lot, since they are targeting that long run equilibrium of 0.71. Anyways, guys, that's what I'm seeing. That's kind of the research that I've done. If you think you see something else, please let me know. I will be leaving some articles down below, which is what I've essentially read and looked at before doing any of this, before sharing all this information with you guys. So thanks a lot, guys, for tuning in. This was the Live Econ Guy. If you can, please leave me a like so we can get the algorithms spreading this video around so more people can see it. Thanks, guys.